Hi there, Evan here at the Chronicle for October 29th, 2019, where the future starts today. First topic I wanted to cover, bond yields. Now I mentioned this in a previous video, which I will link down below, but bond yields have been going higher really since about Labor Day. For reference, by the way, this is globally, not just in Canada and the US, by the way. But I will overlay a chart here of the Canadian 5-year yield, which is the proxy for mortgage rates in Canada. And as you can see, we're up about 50 to 55 basis points since Labor Day. In fact, go back long term here, there's a nice inverse head and shoulders pattern that looks to have formed in the Canadian 5-year yield. And if this is a confirmed break, we could be headed over 2% in a hurry. So go ahead and keep that in mind here. I'll overlay it on the screen here for a few more seconds so y'all can get a better view of it. Now look, of course, for the selling in bonds, there was two triggers. One, it was the US announcing a 50 or 100-year bond to keep rates suppressed and allowing them to borrow more in the long run at those suppressed rates. And secondly, Germany said they want to do fiscal stimulus, which means borrow more money. And because there's negative yields in Germany and most parts of Europe for that matter, although not nearly as much as before, but with those negative yields, they would borrow more money and you have to pay them a dividend for holding their debt. And people turned around and said, I'm not doing this anymore. In both cases, I mean, whether it was the US 50 or 100-year bond to raise more debt, or the Germans saying, we want to do more fiscal stimulus and raise more debt, so you pay us a dividend in the meantime. And this is kind of the main point of what I'm saying here. They were both triggers for the unwinding of excess positioning. That's all it was. Now to be clear, I still expect, because we're going to see slower global growth going forward, that we're going to see lower global bond yields going forward. So that hasn't changed. But does that not mean, because of excess positioning, we can't go up, say, 50 basis points more here in the short term? Sure. But remember, even if we go up that much, we're still making lower highs on virtually every bond yield globally. So that's what I'm saying. So basically, to put it in context, excessive positioning begot excessive positioning. It needed a trigger. It got two of them. People that were late to the game. Because let's be honest, at the end here, everyone, including your long-lost children, believed in lower yields. So at some point here, that's how these things always work out, there had to be a washout. It's happening now. Do expect higher yields in the short term, but longer term, they're still going lower. Now to be clear, whoever buys these bonds, whether it's the private sector, whether it's the central banks via QE, whether, as I think, it's a bit of both, on lower growth expectations and or in an effort to reflate the economy, bond yields are going lower globally in the long term. But the way things are positioned right now, would it shock me if we went up 50 basis points in the short term here, as I believe it looks like we are now? No, it wouldn't at all. And put it in context. Even with this up move, we're still making lower highs. We're still in a long-term downtrend. So let's not lose sight of that. That hasn't changed. Okay? So put it in closing, higher short-term, lower long-term. That's what I think of bond yields. Enough of that. Next topic I'm going to cover, Oxford Economics leading recession indicator for Canada. And what this implies is the percent chance Canada is heading into recession in 6 months' time. And I'll overlay the chart here for you. Right now we're at 72.4%. And any time we've been over 60, it has properly indicated a recession. Now, the first thing I thought of when I saw this wasn't the indicator itself. It's the yield curve. The 10-year, 30-year inverted has since re-steepened. The 1-year, 2-year is inverted. The 2-year, 10-year is inverted. The 3-month, 5-year is inverted. The 3-month, 10-year is inverted. So all 5 major yield curves in Canada either A, were inverted for a very long time and have since re-steepened, or 2, still are inverted and have been inverted for a very long time. So what front ran this? The yield curve. So the first thing I saw when I saw this chart is it looks like the yield curve is right again. Now again, take that personally for what you will, but seeing the accuracy of this indicator in and of itself, and when we've actually had a recession, when it's been over 60%, don't discount it. That's all I'm saying. And frankly, it looks closer to being right than wrong. I'll go ahead and leave it there. And the last thing I'm going to cover today, Benjamin Tal, economist, CIBC, was on BNN Bloomberg yesterday and said that income is a bigger problem in Canada than excessive debt. If you do want to watch the video for yourself, I'll leave a link in the description. But look, total debt service ratios in Canada, even as rates have been in a downtrend for the better part of 30 years now, total debt service ratios are higher. Household debt to disposable income, much higher. In fact, the close to 180% of income where it's at now is roughly 30% higher than where the US was at the height of their housing bubble in 06-07. Consumer insolvencies, the last 18 months, on a clear uptrend higher now. Again, what I'm saying is, as I've been mentioning on this channel for the better part of 2 years now, in fact, you can go back through my previous videos if you want to watch for yourself, when I was crypto and markets and now the Chronicle. Income in and of itself isn't the biggest problem in Canada right now. It's our massive excesses of debt built up and our massive over-reliance on unproductive investment, aka real estate. Because really, that's what's driven the economy for the best part of a decade now, and that wealth effect of rising home prices massively contributed to that also. So frankly, my opinion on the whole thing, for Benjamin Tal to say it, frankly, is ignorant. There I said it. And if you go on with others who are pushing Benjamin Tal's narrative, look at the sectors they're in, and you'll see why. Enough of that, not wasting any more time on it. And frankly, that's it for this video. Smash the like button, leave a comment, subscribe, follow both my Twitter accounts. And as always, my name is Evan. This is the Chronicle, where the future starts today.